There are certain types of mortgages that work perfectly for lenders, but quietly create risk for the borrower who don't fully understand what they signed. So this video is going to walk you through the types of mortgages I regularly tell clients to slow down and think twice about. Not because they are always bad, but because choosing the wrong one at the wrong time can cost you years of financial progress. And if you're buying, refinancing, and if you're especially renewing your mortgage, this might be one of the most important conversations you hear before you sign anything. So let's get into it. The first type of mortgage you should slow down and think about is the one that most Canadians sign every 5 years without even realizing it. And that's the automatic bank renewal. Every 5 years, your lender will send you a renewal letter. It looks simple. It usually takes about 30 seconds to sign, no paperwork, no credit check, no stress. And that convenience is exactly why people take it. But here's the problem. Banks know that a huge percentage of Canadians will just sign the renewal offer without comparing options. So the rate they offer you is often not their most competitive rate. It's simply the easy rate. Now, sometimes the difference might only be 1/4%. That doesn't sound like too much, but on a typical mortgage in Canada, that difference could easily be paying tens, 15, even $20,000 more in interest over the next 5 years. And even more important than the rate is the lack of strategy. When someone signs a renewal blindly, they're not asking questions like, should I change the term length? Should I refinance to consolidate debt? Does this mortgage still match my long-term plans? Because your life today probably doesn't look exactly the same as it did 5 years ago. Maybe your income has changed. Maybe your family has grown. Maybe your priorities have shifted. The key takeaway here is simple. Renewing your mortgage shouldn't be transactional. It should be a strategy conversation. Before you sign anything, always take the time to explore your options. The next mortgage people need to be careful with is a very long fixed rate mortgage, especially 7 or 10-year terms. Now, on the surface, these sound incredibly appealing. The idea of locking in a rate for 10 years gives people a peace of mind. No surprises, no worrying about what interest rates might do in the future. But here's the reality most borrowers don't think about. The average Canadian homeowner does not keep their mortgage for the full term. People move, families grow, job opportunities change, relationships change, or sometimes people simply want to refinance to improve their financial situation. When you're locked into a 10-year fixed mortgage, breaking that contract early can come with extremely large penalties. And in many cases, those penalties are calculated using something called the interest rate differential, which can easily reach tens of thousands of dollars. I've seen it where the penalty to break a mortgage was larger than the homeowner's annual income. So the lesson here is not that long-term fixed mortgages are always bad. But before locking into something for 10 years, you need to ask yourself one question. How confident are you that your life will stay exactly the same for the next decade? Because flexibility is often more valuable than certainty. The third mortgage people sometimes rush into is the deep discount variable rate mortgages. Now, variable mortgages are not bad. In fact, historically, they have often saved borrowers money over the long term. But the key word here is understanding. Because what many people learned over the last few years is that variable rates can behave very differently depending on the mortgage structure. Some borrowers experience something called trigger rate, where their payments suddenly had to increase. Others saw their amortization stretch far beyond what they had expected. And many homeowners realized they had chosen a variable simply because it was cheapest at the time, not because they understood how it worked. When interest rates were rising quickly, the lack of understanding created a lot of stress for people who were not prepared for volatility. The key point here is simple. Variable mortgages can be a great tool, but they work best when the borrower fully understands the potential ups and downs and is financially comfortable handling that flexibility. Choosing variable just because it's the cheapest option today can sometimes create surprises tomorrow. Next on the list are mortgages that come with very large penalties if you break the contract early. This is one of the biggest misunderstandings borrowers have about mortgages in Canada. Many people assume that if they break their mortgage early, the penalty will be a few months of interest, and sometimes that is true. But in many fixed rate mortgages, especially with some major banks, the penalty is calculated using a much more complex formula. And depending on the interest rate environment, those penalties can become extremely large. I've personally seen homeowners shocked to have learned that their penalty was $20, $30, even $50,000 just to exit their mortgage. Now, the important thing to understand is that this doesn't mean the mortgage itself is bad. It just means the borrower wasn't fully aware of the exit costs. And that's something that you should always understand before signing. Because the best mortgage is not just about the rate you start with. It's also about flexibility you have if life changes. Another type of mortgage that can look very appealing at first is the cashback mortgage. These are mortgages where lenders give you a lump sum of cash when you take the mortgage. Maybe it's $5,000, maybe it's $10,000. And for many buyers, especially first-time buyers dealing with closing costs, that sounds incredibly helpful. But here's what many people don't realize. That money isn't really free. In most cases, cashback mortgages come with higher interest rates compared to standard mortgage options, which means over time, the borrower often ends up paying that money back through higher interest. And on top of that, many cashback mortgages have clawback penalties if you break the mortgage early. So if you refinance or sell before the end of the term, you may have to repay the entire cashback amount back. Again, this doesn't mean cashback mortgages are always bad, but you need to understand that the money is typically built into the cost of the mortgage. Another mortgage people need to be cautious about is something called a no-frills mortgage. These are often mortgages that advertise the absolute lowest interest rates. And while rates may look fantastic, these products often come with important restrictions. For example, some no-frill mortgages don't allow you to refinance during the term. Some limit your ability to move the mortgage to a new property. Others come with higher penalties if you need to exit the contract early. So while the rate might look amazing on paper, the mortgage itself might not give you the flexibility you need if your plans change. And the reality is, life change happens more than a lot of people expect. That's why I always encourage borrowers to look at the whole structure of the mortgage, not just the interest rate. The next mortgage we're going to talk about are interest-only mortgages. These are mortgages where monthly payments only cover the interest portion of your loan. Your principal balance doesn't decrease. Now, these types of mortgages can absolutely make sense in certain solutions. For example, real estate investors sometimes use interest-only structures to maximize cash flow. But for regular homeowners trying to build equity in their home, this strategy can sometimes create problems. Because if your balance never goes down, you're relying entirely on the market increasing the value of your home. And if home prices stall or decline, you're not building much financial progress through your mortgage payments. For most homeowners, a traditional amortization mortgage helps steadily reduce the loan balance and build equity over time. The next mortgage we're going to talk about is private mortgages. These are another area where borrowers need to be careful. Private lending can be a very useful tool in certain situations. Maybe someone is self-employed and needs time to improve their financial statements. Maybe someone is dealing with credit challenges that needs to be repaired. In those situations, a private mortgage can act as a short-term bridge. But the key word here is short-term. Private mortgages often come with higher interest rates and fees. So entering a private mortgage without a clear plan of how you will transition back to a traditional lender can become very expensive. If private financing is part of the solution, there should be always a clear exit strategy. Another common mistake is choosing a mortgage term simply because it's the most common option. For many years in Canada, 5-year fixed mortgages have become the default choice. And while it can be a great option in many cases, it's not automatically the best choice for everyone. The right term length should really depend on your personal financial situation. Are you planning to move in a few years? Do you expect your income to change? Are you anticipating major life events like starting a family or changing careers? Your mortgage term should align with your life's timeline, not just what everyone else is doing. And the final mortgage mistake isn't actually about the mortgage itself. It's about how much debt people take on. Many buyers focus on the maximum mortgage amount the bank approves. But just because you qualify for a certain number doesn't necessarily mean that number fits comfortably within your lifestyle. Home ownership comes with many other costs. It comes with property taxes, maintenance, utilities, insurance, and sometimes unexpected repairs. Choosing a mortgage payment that allows you to still save, invest, and enjoy life is often a much healthier long-term financial decision than stretching to the absolute maximum approval. The truth is, there really isn't one perfect mortgage for everyone. The best mortgage is the one that matches your financial goals, your timeline, and your level of flexibility. Because the mortgage you sign today should still make sense for your life 3, 5, and even 10 years from now. And if you want more clarity on how to pick between a fixed and a variable rate mortgage, I'll link that video right here for you to watch and enjoy. Thanks for watching, and I'll see you in the next video.